Welcome to this explainer. Today, we're diving straight into a massive corporate illusion. We're going to uncover exactly why a company boasting about record profits might actually be secretly going bankrupt right under your nose. It sounds crazy, right? But by the end of our time together, you'll be able to see right through the whole shebang.
Picture this deeply frustrating scenario. You know the one. You're sitting in your all-hands meeting and your boss stands up there grinning from ear to ear, bragging that the company just hit absolute record profits. Everyone claps. But then, a few weeks later, you ask for a raise or, I don't know, maybe just a new coffee machine for the break room, and you hit a total brick wall. They tell you, sorry, money is really tight right now. It's like, what? You literally just wanted to scream, didn't you?
It sounds like a massive corporate lie. How on earth can a highly profitable company not have enough actual cash to buy coffee? Well, here is the terrifying part. They might actually be telling you the exact truth. A business can be making millions in profit on paper and still be completely broke. But don't worry, we're going to expose the exact accounting mechanics happening behind the scenes that make this completely legal and honestly, entirely possible.
Here is our roadmap to dismantling this illusion. We'll start with the corporate profit illusion and the accrual trick. Then, we'll break down the 3 traps where cash goes to die: fake expenses, accounts receivable, and unsold inventory. Finally, we'll track down the real cash. Section 1. The corporate profit illusion.
To get this, we really need to look at the fundamental difference between common sense money and corporate accounting rules, because frankly, they're practically speaking 2 totally different languages. Most of us think, hey, if a business is profitable, it obviously has money in the bank. That makes perfect sense to our everyday brains. If a crow flying around finds 10 shiny coins and spends 5, that crow clearly has 5 shiny coins left in its nest. Simple math, right? But the corporate world doesn't work like that at all. Corporate logic operates on a system where money is frequently recorded on a scoreboard long before a single coin ever reaches the nest.
Section 2. The accrual accounting trick. This brings us to the primary antagonist of our story, which is a little corporate magic trick known as accrual accounting. Look, if you've ever felt gaslit by a financial report, this is exactly why. Accrual accounting basically means a company records money when they earn it, not when they actually physically receive it in their bank account. So the absolute crucial takeaway here is that to understand why your company is broke, we have to look right past that shiny net income number at the bottom of the income statement. That number is just an accrual mirage. Instead, we have to examine the cash flows from operating activities. That is where the truth lives. Now, to figure out the real money generated from everyday operations, accountants use something called the indirect method. They act almost like financial detectives. They start with that beautiful, heavily celebrated net income number, and then they completely tear it apart. They make a series of crucial adjustments to strip away the accrual magic and reveal the actual cold, hard cash flow. How do they pull this off? Well, they do it by walking through the 3 biggest traps. Section 3. Trap 1. Fake expenses. To see how this illusion is built on paper, welcome to the wild world of fake expenses. The biggest culprit here is something called depreciation expense. Just imagine your company bought a massive, state-of-the-art printing press 5 years ago. It costs an absolute fortune. Under accounting rules, every single year, they subtract a chunk of that printer's value from their current profits as a depreciation expense. This automatically makes their net income drop on paper. But wait a second, did they actually hand anyone cash for that printer this year? No way. That physical cash left the building 5 years ago. When we look at the category of depreciation, you'll see something super interesting. Because no actual cash left the building for that printer this year, since it was just a ghost expense on a spreadsheet, accountants actually have to add that depreciation amount back to the net income to find the real cash flow. So on paper, the profit looks lower because of the expense, but the actual cash in the bank is higher than the net income suggests. But hey, do not celebrate just yet, because the next 2 traps reverse this dynamic completely. Section 4. Trap 2. Accounts Receivable. Okay, this is where the illusion completely falls apart and where the real disaster happens for your company's bank account. It's all about changes in current assets, which is really just the short-term value a company holds, like cash or expected payments. Picture the scene. Your company just closes a massive $1 million software deal with a new client. The sales team is high-fiving, the boss is ringing a literal brass bell in the hallway. That entire $1 million gets slapped immediately onto the income statement as revenue. On paper, the revenue shoots through the roof. It makes net income look absolutely incredible. The company looks filthy rich. But if you check the actual cash received, it is completely empty.
This brilliantly illustrates the ultimate catch known as accounts receivable. Just follow this timeline with me. Day 1, you close the deal. Day 2, you record the massive revenue. But your client has net 90 payment terms. That means they don't actually have to mail you a physical check until day 90. That revenue is artificially pumping up net income today, but zero cash has actually been received. Because of this, our financial detectives, the accountants, they have to subtract that entire $1 million right out of the cash flow statement. So your boss is staring at a profit report that says they're millionaires, while the corporate bank account is literally sitting at zero.
Section 5, Trap 3, Unsold Inventory. Now, if accounts receivable is a waiting game, this next trap is an absolute black hole for corporate cash. Say your company sells physical products instead of software. To ensure they never ever run out of stock and miss a sale, your company decides to spend a ton of actual physical cash right now to buy a massive warehouse full of goods. Just picture it. Thousands of unsold ergonomic desk chairs physically sitting in a massive, dusty warehouse in Ohio. Here is the inventory magic trick. Cash is spent immediately to buy those chairs, right? But under corporate accounting rules, those costs do not hit the income statement as an expense until the specific items are actually sold to a customer. This means your company's net income looks perfectly fine right now because those massive expenses are completely hidden from the profit and loss report. The company looks incredibly rich on paper, but their actual cash, it's completely gone. It decreased massively because it was basically converted into thousands of physical chairs just sitting in Ohio. Section 6. Finding the real cash. So, we've torn apart the income statement and seen exactly how fake expenses, accounts receivable, and inventory completely disconnect profit from reality. But why does this actually matter for us everyday employees who are just trying to survive the corporate world? Well, it matters because you need to stop blindly trusting the word profit. You really have to realize that a business can report record-breaking net income on their fancy all-hands slides while simultaneously going completely bankrupt in reality. Why? Because all their actual money is hopelessly tied up in unpaid invoices from clients taking 90 days to pay and giant piles of unsold inventory sitting in a warehouse. They have paper wealth, for sure, but their actual bank account, which is shown on the statement of cash flows, is bleeding out. So here is your actionable takeaway from this explainer. Next time your company has a quarterly update and the executives start applauding themselves for announcing record profits, don't just mindlessly cheer along. Make those executives sweat a little bit. Raise your hand and ask this exact, incredibly precise question. What explains the change in our cash balance this quarter?
That question cuts right through the accrual magic trick and demands to know the reality of the business. Learning to read between the lines of corporate success is exactly how you stop getting played by the system. It empowers you to understand the true financial health of the place where you spend 40 hours a week. Which leaves us with one final question for you to consider. Now that you know the difference between the illusion of net income and the reality of cash flows, will you ever let a company boast about record profits the same way again without checking exactly where the cash is hiding?